Welcome back to another episode of Freedom Finance with Lanny, guys. We're going to change it up a little bit on today's episode, and we're going to dig into high yielding investments. And if you've stumbled upon high yielding videos or dividend investing videos, there's a chance that you may have heard of two exchange traded funds or ETFs, JEPI and JEPQ. JEPI and JEPQ. And they both yield right now between 7.5% and 10.5% respectively. But the question always is what's the deal with these two ETFs that you might hear about all the time on blogs, on Twitter or X, on YouTube, on TikTok, you name it. You probably have seen somebody talk about it if you've landed on some high yielding portfolio or a high yield investment. So my job here today is to kind of clear the gray and get into the more black and white with what the deal is with these two high flying, high yielding ETFs, and really what type of an investor should be looking at these, and really what these ETFs do or what the fund managers do within these ETFs, guys. So if you're down with this video, grab your favorite beverage, your beer, your liquor, your wine, because you're Italian this weekend, baby. But it's Sunday morning, so grab your espresso, your coffee, your tea, and let's dive in to JEPI and JEPQ and unveiling what the heck these two ETFs are all about. Let's get it. So it's all about income for these two ETFs. These ETFs, the J really stands for JPMorgan. And, we're going to break down a few facets within each of these ETFs. But it's very interesting because the same fund manager or portfolio manager for one is also the same for the other, even though one has been around a few years longer. JEPI has been around about 2 years longer than JEPQ. 2020 is when JEPI was created, and the inception for JEPQ, I believe, was in mid-2022. Somebody could fact check me on that. But these ETFs are all about income. They're all about developing and creating that passive income, that premium income. That's really the P, is premium in the JEP on both of the ETFs. So really it's the JPMorgan Equity Premium Income Fund, and the other one really is focused on, it's the same. It's an equity premium income fund, but the other one's really focused on the NASDAQ 100. But both are in the premium income for you and your portfolio here. So again, there's the two differences right off the bat, though, is what the index is, as I just said. JEPI or JEPI really is focused on, again, we'll get into the details, but we'll call it the index that it likes is the S&P 500. And JEPQ, really take the NASDAQ, the Q off that, is really about the NASDAQ 100. So that's really the difference on what these two funds are looking at. Now, they're not supposed to track, the indexes themselves. What the fund managers do is their goal is to have and write out of the money options on positions within each ETF. And we'll get into what the heck that means. Out of the money or OTM and options and put options, call options, green jacket, gold jacket. Who gives a... No, I'm just kidding. But, just kind of table that because we'll get into it. And the expense ratios on both of these ETFs, again, they're an exchange traded fund. So it's not a one individual stock. It's a basket of positions within the portfolio. So they have expense ratios with it for the fund managers to put in their pocket. JP Morgan, Jamie Dimon tipping that cap is 0.35%. So both are the same expense ratio. Kind of goes in line with the same name, the same fund manager, and the same philosophy. Again, writing out of the money options on positions within each respective indices. What exactly is in each, indices that it's being referenced to? Well, JEPI, it's going to have your Microsoft, your Apple. Think about your top 500 companies, your ExxonMobils, your Chevrons, your Progressive, etc. Whereas JEPQ is going to be all really big tech, right? You're going to have NVIDIA, Apple, Microsoft as well, Google, Meta, Broadcom, just some other big tech names that are in the industry. So that's kind of the big stocks that are, within each portfolio that they are writing these hopeful out of the money options on. Now, what about the yield? What about the dividend yield? Because you've seen them, guys. JEPI yields around 7.5% at the time of this video based on, I think, the latest dividend that was announced and then projecting that outward. And then JEPQ actually yields higher at 9.5%, guys. So JEPQ and JEPI are two high-flying, high-yielding ETFs just cranking out passive income. Now, I will have to make a note, too. These pay on a monthly basis. You like having a monthly check, right? Well, owning these ETFs will give you a monthly distribution and monthly cash flow for you. The one caveat is it's not a consistent dividend every month. It is going to be a variable dividend every single month. So just keep that in mind. You can't really anticipate it being the same. You can't anticipate it always growing either next month. So you have to keep that in mind. How have these ETFs performed this year? Well, JEPI's up about 3%. JEPQ's up anywhere between 9 and 10%, I believe. Again, I'll throw them on the screen here during the edit here just so we can prove that out. So let's get into it then. So what's the deal? A variable monthly dividend. They're here to create premium. Where is this premium coming from? Well, when you write an option on a stock position, you earn a premium on that. Now, you get to keep the shares if those options expire out of the money. So you want, for instance, your call option to be lower than the strike price. And then you want it to expire worthless or out of the money so that you can keep the premium and keep the shares, right? And then if you are writing and selling a put option, you're collecting the premium, and then you're hoping that that stock price stays above that strike price by the expiration date. Again, out of the money, expiring worthless. So the goal here with these fund managers are to write these options, whether they're call options or put options, and they want them to be out of the money, aka they want to keep the premium. Because again, if something else happens and they might be selling at a loss, or possibly selling at a gain, all just depends. And then the premiums that they make gets kicked back to you, the shareholders. Now, based on their activity any given month, that's why the dividend is variable every single month, because you don't know how much premium you're going to earn every single time you write that option. So now the better that they write these options, the more often that they write these options, and the more often that they expire outside of the money or out of the money, the better this ETF will perform, the better the distributions will be for you, the shareholder. So that's the deal with JEPI and JEPQ. The fund managers are writing options to other investors out there that are looking to buy options, and the fund managers at JPMorgan want them to be out of the money so that they can keep the premiums, boosting their performance, giving you back a monthly dividend. That's the overall goal, and to beat their respective indexes. Obviously, JEPI, the S&P 500, and then JEPQ, NASDAQ. So that's really it in a nutshell, guys. Let me know what you think and if you own JEPI and JEPQ. Be curious in the comments now, based on that understanding as well, what you plan on doing with, are you going to buy JEPI? Are you going to buy JEPQ? When I look at these two ETFs, I think of it as, hey, you want to generate some additional income and you're not comfortable maybe yet writing options yourself or doing anything related to options, then maybe you just want to give JPMorgan $1,000, $5,000, $10,000 and, create some additional income this way. Maybe you'll use that income. Maybe you'll reinvest it to buy more JEPI, JEPQ shares, or maybe you'll use that for your everyday living expenses or to buy other stocks or ETFs. But maybe that's one of the reasons. Another reason you might want to buy JEPI and JEPQ is you are in the options game, and you kind of want to at least have another option strategy, a basket strategy, a lower risk strategy. So you buy JEPI, JEPQ to go along with your own way of writing options. Again, I've dabbled in writing call options myself for positions that I own 100 shares or more of. I think out of the, 30 to 50 options I've written over the last year or so, I think one has actually, expired, and I actually had to sell shares because I do covered call ETFs. So the hit ratio is pretty good on my side, being out of the money and expiring worthless. But maybe you want to do JEPI, JEPQ to help with your success in the options game. But why would you buy JEPI, JEPQ? What is your reason for owning these ETFs? Very curious. So please leave those comments below. Now, if this helped break down the two ETFs, the two high-flying, high-yielding ETFs, let me know as well, because that's the name of the game here on this video, was to unravel what the heck these two ETFs are about, guys. So that's JEPI, that's JEPQ. I personally don't own these at all in my stock portfolio, but again, curious if you hold them in yours. Leave some comments too on some other videos that you want to see. Like the video if you haven't already. Subscribe to this channel, and I will catch you on the next one.